Hey, thanks very much. Welcome back. Kirk Conover, thank you. Kirk has just left the building. Chuck Malamut is here. Chuck is our official financial advisor to the Hurley in the Morning program in his 26th year with us here as our official financial advisor and also as our broadcasting partner. Chuck is the managing director. He leads his group, the Malamut Group, at Morgan Stanley's Northfield office, 609-383-2010. If you reach out to Chuck and his team, they will introduce to you their perfected concept of total asset management coupled with the all-important asset allocation. And the program that you're about to listen to is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member, SIPC. Ladies and gentlemen, we welcome Chuck Malamut. I don't know how much of the last hour you had the opportunity to listen to, Chuck, but it was so enjoyable listening to Kirk, and even listeners, acknowledged how just informative and how nice it was. And we do have a lot of bad news these days. It was just nice to listen to something cultural like that. And I know that's an area that you've been to, Chuck.
So many years ago, Harry, long before terrorism, certainly. And
did you like it? But Kirk even mentioned I brought terrorism up. He said not a whiff of it, not an issue. Nobody thought about it. So it's kind of neat sort of suspension of belief. You can get away. You know, they work very hard, as you do. They work very hard owning their business and operating their business. And it's nice, that they were able to get away for a couple of weeks. And you decompress and you come back happy and you're ready to, and recharged to get back into it. But I understand. I mean, I only know it through sights and sounds and seeing things on TV and reading about it all. But evidently some incredible sights.
Magnificent part of the world, there's no doubt about it. And Venice was wonderful. Rome, I mean, you think about the history that was created, and the Colosseum was just a remarkable place. I remember, Harry, I'm going to tell you, I was there over 20 years ago, and still remember it. And Bullet Train. Now, as Kirk mentioned, there was no language barrier. Unfortunately, when we were there was somewhat of a language barrier.
So a lot's changed.
Quite challenging trying to figure out when you're in a train station and nobody spoke a lick of English.
Wow.
And I think we were traveling from, I'm trying to remember I can't remember the destinations, but I do remember we were on the Bullet Train, and I was just happy to get on the train and get to our final destination.
And know you were going the right way.
It was a little stressful, but
when you don't know if you're going the wrong way or the right way or whatever's going on.
I guess worst case scenario is if you get lost, you can always find your way at some point in time.
So, Chuck, what's the market update?
Well, Harry, it seems as if we are maybe somewhat in this summer doldrums. I mean, there hasn't been. I'm going to probably regret what I'm going to say here in a second, because there has not been a lot of volatility of late, and I think no sooner do we say that, are we going to say that something will happen. But I mean, if you take a look at last week all into itself, as we finished up the month of July, and the month of July was a very good, very good for the equity markets. Last week basically flat. The S&P was down, 10 basis points. The Dow Jones was down, 0.8% for the week. The Nasdaq was clearly the winners. We're starting to see some shift of movement of where investors are going. So the Nasdaq last week was up 1.2%. So, the major indices right now are up over 7%, that being the Dow and the S&P year to date. And if you think about it, we got a lot of that accomplished in a relatively short period of time. I mean, we came out of Brexit, as you know, that Friday was just not a great day, down 600 on the Dow. The following Monday, down 200, and then the realizations were, started to come back and say maybe things are not as bad as we are envisioning here. Mm-hmm. And then as we got through the latter part of June and in July, we tacked on some fairly, healthy gains, within the equity markets. The MSCI emerging markets, which everybody kind of wrote off at the beginning of the year, it's clearly the winner, globally here, up 12% year to date. And, we are really laser focused on what's happening still in the UK. So it's actually not a terribly bad sign, Harry, that the FTSE 100, which is the UK that we measure up against, is down less than 1% year to date. So the concern, I guess, with Brexit and where we go and who's coming next, and the Italian banks not getting to their stress test and making them, it might be overdone somewhat, but I still think you need to be somewhat cautious, moving ahead. Because equities are, basically at, close to or not all-time highs. I mean, the Nasdaq put a high in yesterday. Previously the S&P did a couple weeks ago. So there's not a lot of places to go because fixed income. I mean, the rates are the rates. I mean, we are in a very, very, as you know, low environment. I don't like using the terminology, the new norm, but I know that you are terribly amped up as to, I heard you this morning and yesterday. I had to take a break. I didn't want to.
This morning, 6 o'clock hour, should all 315 million Americans should have a headset put on them, and they should have to listen to that hour.
I was tempted to call you over the weekend, but I figured I wanted to take a little bit of a breather, so I thought it'd be best not to talk about politics.
It's crazy times. Let me throw out, this is really, I think, very interesting that we can use the S&P 500 as an election predictor. And here's the story, ladies and gentlemen. And I'll be writing about this in the near future, but I'm giving it to you as a Hurley in the Morning first. And I saved this for Chuck's program. 1984. Now, we're comparing the S&P 500 return versus the prior year. So if it's up or it's down. 1984, the S&P 500 return was 4.8%, and the incumbent party that was in office won the presidency. That would be Ronald Reagan running for re-election. So the Republican Party was the incumbent party. He won re-election in 84. The market was up. 1988, S&P 500 returned 1.9%. George H.W. Bush won the presidency in 1988 over Michael Dukakis, and I'm going to keep going. 1992, the S&P 500 returned negative 1.2%. The incumbent party lost the election. Bill Clinton defeated the incumbent president. Very rare for an incumbent president to be defeated. The market was down 1.2%. The incumbent party lost. 1996, the S&P 500 returned 8.2%. The incumbent party, Bill Clinton running for re-election against Bob Dole, won the election. The election of 2000, the S&P 500 returned minus 3.2%. What happened in the year 2000, Chuck? You can do it. You can do it.
No, I don't want to.
George W. Bush became the president. He was the president of the opposite party. The incumbent party lost the White House because the S&P 500 was down 3.2%. President Bush ran in 2004. The S&P 500 returned 2.2%. The incumbent party won the election. The election of 2008. What happened in 2008, Chuck? Who won the election?
We know that, Harry. We're not going to go there.
So you have, again, this is not politics. This is your ballywick, Chuck. This is the S&P 500 as an election predictor. The market, the S&P 500 was down 19.5% in 2008. The incumbent party lost the presidency. In 2012, the S&P 500 returned 2.5%. The incumbent party won the election. Chuck, the S&P 500 right now is up.
Up 7.7%, Harry.
And this has been correct for, let's see, 84, 94, 2004, 2014, 32 years. This has been fail-safe, foolproof. As it stands right now, I absolutely believe the S&P 500 is going to be up for the year. And the election predictor model of the S&P 500, and it's returning positive or negative gains, and which party will win is cast if it continues. I think that's an interesting look at financial numbers and how it's played out.
I think obviously the election has a fair amount to do with the equity markets, at least on a short-term basis. I mean, there's been all kinds of discussion as to are the markets better served by having Trump or having Clinton? We could spend the next hour, discussing and debating. I mean, bottom line,
I almost think that isn't even in the equation. I think this is happening. It's really weird how this can become sort of math. But did anybody really think? I mean, I guess maybe they did, that Bill Clinton would be a better shepherd than George H.W. Bush, because it happened, or that George W. Bush would be a better, shepherd than the previous 8-year incumbent vice president. The S&P 500 return, when it is positive, the incumbent party wins. When it is negative, the incumbent party loses. And that's about how many elections in a row? 1, 2, 3, 4, 5, 6, 7, 8 straight elections. I think it's interesting.
Yeah, so I guess you're looking for a major pullback in the markets then.
Well, I always root for my country, though. That's the issue. I root for my country, so I can't root for that.
Yeah, so I guess you have to take a step back and you don't go left, you go left, or you go right.
You didn't expect that, did you?
Yeah, I guess you're a little conflicted there, are you?
I'm not conflicted because I always root for my country. I want my country to do well. Now, you could say a momentary slip up, could bring this into negative, and then it goes right for the next 4 to 8 years. There's always a way to skin the cat, but I always root for us to do well. I don't ever want to see people have stress and lose, and have that. So I'm pulling for, our markets to, to continue to do well. As of right now, Chuck, the S&P 500 is up how much?
It's up, Harry, it's up 7.7%.
Yeah.
Year to date, and as I mentioned a few
minutes
minutes ago, it all happened. Yeah. It all happened in a relatively short period of time. It seemed as if we treaded water for a good portion of 2016, and then all of a sudden you sort of flip the switch, and the markets, have now moved in a positive fashion. I think there's a lot of reasons, one of which we're continuing to see earnings, even though the numbers that were projected have been, significantly reduced year over year. It seems as if we sort of got to that earnings trough at Q1 2016. Now we're seeing results for the most part either, meeting or beating expectations, and what is really good to see, Harry, for the first time in a long time, we're seeing the top line number coming in excess of the forecasted number.
That's big because, a lot of times, Chuck, you were giving results of bottom line success, which involves a lot of other things, cuts and, different operational efficiencies. But when you're hitting the top line, that is a big deal, isn't it?
It is. And so you look at today, not that we're going to focus on the day in particular, but, Procter & Gamble came this morning, about an hour ago. Pfizer came as well, and both of those companies do a fair amount of international business, and I know they beat on the bottom line, and I'm almost certain they beat on the top line as well. So it seems as if even though we are growing ever so slightly, and I'm really surprised, Harry, it's 8.19,
yes,
and I haven't heard it from you. I guess maybe you're still thinking about all those good thoughts that you and Kirk had over the last hour as to what in the world is going on here domestically, in our country.
Oh, no, we would get to there. Don't you worry, Chuck. We're going to get our first break in. You're listening to Chuck Malamut. For all of your financial planning needs, turn to Chuck and his team, the Malamut Group. Chuck is the managing director, and he leads the effort at the Malamut Group at Morgan Stanley's Northfield, New Jersey office, 609-383-2010 for all of your financial planning needs. And when I say all, I mean all. If you're planning a vacation, if you're planning your retirement, if you're planning college building years, all of it, Chuck will sit down with you and get to know you and really listen to you in terms of what you're looking to accomplish, and you'll be in very good hands. Tell Chuck that I sent you. 609-383-2010. We'll take a brief time out. We'll be right back with Chuck Malamut. We're going to get to this whopping second quarter GDP when we come back because it's just doing fantastic. That's up next, and Chuck will also talk about the Fed, oil prices, which yesterday was an interesting day. Prices are at like a 4-month low. Market leadership and a whole lot more with Chuck Malamut. This portion of our program also brought to us in part by the Virginia Hotel. The Virginia Hotel is part of the Cape Resort Properties. It's a fantastic property. Undeniably, and I've never heard anybody take exception when I say this, that the Virginia sets the standard for luxury hotels in all of Cape May. It's also very exclusive because they have just 24 guest rooms. Now, I'm not counting the cottages, which are these freestanding full homes that you can also rent. You can rent them for personal, for business. I mean, they're fantastic. You have your own home in Cape May. But the cottages are separate homes. We'll talk about them in a moment. The guest rooms, just 24 of them at the Virginia, provides that truly intimate environment, and they do a great job. They balance modern and classic. It's really very, very well done. Reservations, call 800-732-4236. You can ask about the Life's a Beach special seaside getaway that's in effect right now. Also, the Benjamin is back. That's a $100 resort credit. And hot dates for the month of August tomorrow, August 3rd, August 7th, August 11th. And you'll take a 10% discount off of the hotel rack room rate at the Virginia Hotel, 25 Jackson Street in Cool Cape May, 1/2 a block off of the beach and the beautiful Atlantic Ocean, nestled on a tree-lined street. You almost forget till you walk out, and then you just pop right out 1/2 a block away, and you're literally right on the beach. They do a great job. The Ebbett Room is fantastic, great experiences. They have great concierge. The weddings and events and specials that are happening at the Virginia, give them a call, toll-free, 800-732-4236. Back with Chuck Malamut in 2.5 minutes. Hey, thanks very much. Welcome back. 25 minutes past the hour. All right, so Chuck, you did an awesome job on the market update. Now,
let's talk about your favorite subject, Harry. Well, one of your favorite. Well,
GDP?
Yeah. So second quarter growth, was remarkably weak.
I mean, what's 1.2% amongst friends?
Now, but let's. It's not all. It's
not as bad as it seems.
Because
it's the new normal, Chuck.
No, Harry. Just hold on a second now. Just give me the floor for just a second, okay?
Please.
So GDP expanded by 1.2% for the quarter.
What was the forecast?
It was in excess of like 2.5.
Yeah,
I believe.
I think it was 2.6.
So that was obviously well below expectations. Now, the number one reason was because of inventories. That represented the biggest drag out there, and business investment was soft as well. However, what was interesting here is the fact that consumer spending climbed 4.2% for the quarter. So all is not dead.
So that's confidence there.
Yeah, all is not dead. With not only the consumer, but hopefully we can get businesses to start spending. And Harry, I had an opportunity to travel this weekend. I was outside of the state of New Jersey. And it was interesting to see that where we were, it was thriving, and certainly not like what we are witnessing here locally, and that is all a good sign as well that the economy
that is a very fair point. There are many states in this country where it's actually booming right now. We're just not experiencing
exactly.
it. Yeah.
So we were in Kentucky,
but still, the overall number though is 1.2%.
It is 1.2. So that's something that obviously needs to be worked on, and maybe with these corporate earnings coming, and again, expectations are, and we've been hearing as we get to the latter part of the year, GDP in excess of 4%. Now, I think unfortunately, Harry, is every time we get a number, and that's the forecast, then as the number shows up, or is calculated, it turns out to be significantly less.
We're revising downward.
We
a lot.
are,
yeah.
Mm-hmm. So
1.2 might also be fractional growth. Was the first quarter 0.9?
It was.
Okay, so if we income average the two, we're at basically
we're
like
1%.
1% growth for the whole year. This is the first time in the history of the country that we're basically going 8 years without at least a quarter of GDP at 3%. It's amazing, actually. And I'm not going to accept that this is our new normal. It's never been accepted, tolerated in all of American history. Why would we tolerate it now except for political reasons, which this show during your time here is not about? So to me, it is unacceptable.
Well, Harry, look, it obviously is unacceptable for all of us, and it certainly is unacceptable for all of us here locally, because I think we'd be quite happy at 1 point. I think we'd be kind of happy at 1.2%. At least in the South Jersey area.
Yeah, crazy to think that, but
it looks like it looks like, Harry, unless, and again, I'm not going to talk politics, but November's right around the corner, and not only we focused on
98 days.
Not only we focused on who the next president is going to be, we're focused on North Jersey and
I'm getting more and more confident we're going to beat that question, Chuck.
I saw there's another coalition that was formed. I'm
on the
North
record
Jersey.
long ago making the prediction we will defeat that question. It's going down.
And it should, Harry, quite frankly. I mean,
it
doesn't,
should.
When you think about it, it doesn't. I don't think anyone
it's not going to help our
it.
state. It's going to hurt our state.
Exactly.
It's not even being parochial. Sure, it's terrible for us down here, but it's bad for our whole state. So that would be, Chuck, I have to say, you talk about a game changer here in the South Jersey market. Defeating that question, I think we will see a lot of stability come as a result of that.
Cool.
Because you know how it works, Chuck. If you have something that is game changing that's a few months away, you're not going to do that renovation or that other type of upgrade or reinvestment. You're going to wait to see how it goes. So when we beat that question, then the size of our jurisdiction is right-sized, and I think we get it to the next level after that question is beat.
Well, look, the developers are sitting, on their hands just waiting to see whether or not
can't blame them.
It makes sense to invest in the area. If you remember, Harry, several weeks ago, we had a discussion with a number of very fluent out-of-towners, and I think they were sort of here on a fishing expedition as well.
That was
to
a
have some fun.
That group was
and
a delight.
Who knows? They might have walked away from that and saying maybe there are opportunities here, but we need to sort of wait and see as to what the results of that November election will be.
I also think that group was enlightened to the many upsides of this area as well, Chuck.
Oh, absolutely. I mean, they spent 48 hours here, and the reports I got back, they were very, very pleased with what they saw, particularly everything else. I mean, Ocean City, Cape May, Avalon, Stone Harbor, they were very impressed there. But, obviously Atlantic City is Atlantic City. And they were a little disappointed, but they understand that, the track that Atlantic City is currently on.
We're at 31 minutes past the hour. One more break, and then we have another power segment with Chuck Malamut straight ahead. The topic will shift to the Fed when we come back. Oil prices, market leadership, and anything else that Chuck wants to close out with. He'll be with us until about 45 minutes or so past the hour. We have coming up in our fourth quarter wide open forum, and we're going to take full advantage of that, take your phone calls one after the other on anything that you want to talk about. And a reminder for all of your financial planning needs, turn to Chuck. The Malamut Group is the team that he leads at Morgan Stanley's Northfield office, Northfield, New Jersey, right here in Atlantic County. 609-383-2010 is the phone number, 609-383-2010, and Chuck and his team can help you with all of your financial planning needs. We'll be back in 3 minutes. Hey, thanks very much. Welcome back. 35 minutes past the hour. Chuck Malamut is here, and you can sort of set your watch, your calendar on the fact that it must be Tuesday morning in the 8 o'clock hour because Chuck has held this spot for over a quarter of a century. We've been doing this program together. Chuck, the Fed, how's life?
So, Harry, if you take a look at last week, it seems as if the Fed is now at the point in time where they're getting the market prepared, for, and you're going to probably fall on the floor when I say this, but they are truly looking, for some sort of a rate hike. I mean, the comments...
No, I'm not surprised. You know my position on this. My position is one rate hike after the election.
Yeah, so they stayed put last week, but they upgraded their economic view, keeping the door open for a 2016 rate increase. It looks as if, while we don't see anything near term, the Fed's going to probably, unless the numbers dramatically change in a negative fashion, don't be at all surprised if they come in December with some sort of a some sort of a hike.
That's what I've been saying all along.
Not that I'm suggesting
and
that
they're not political, but yet they're very political because, come on, if you're going to raise them December after the election, not to be confused with when they raised them in 1992 twice before the election. Twice. So anybody out there that doesn't believe politics is everywhere, it's in Little League, it's in this stuff, it's in everything. But I said it when everybody was saying there would be a rate increase. I kept saying, no, there won't. No, there won't. No, there won't, because I know politics. But there will be a rate increase, and I agree with you, Chuck, unless – and it seems as though every time they've been just about ready to do it, something happens to stop them.
Yeah, so you were talking about we had Brexit, and there was discussion there, and the obviously all the terrorism overseas, that has an impact. So what has happened, the inflation data that's come across and the U.S. labor statistics that have come across over the past several weeks, are pretty much confirm the fact that the Fed is probably just going to raise rates once this year. And I'm guessing
in December,
later rather than sooner.
Of course.
So we'll come in December.
And it'll just be a coincidence.
Yeah.
How about oil prices? Am I correct, Chuck? Are they down?
Yeah, Harry.
4 months ago?
If you think about it, up to yesterday. I mean, today looks positive in the oil markets, but oil has come under a lot of pressure of late, and it's softened in recent weeks because we've had an increase in inventories and a lot of oversupply. So the trends will probably continue, at least on a short-term basis. And while I don't want to say it's range-bound, but you think about it, 60 on the high side, maybe 30 on the low side.
And we're at 40 right now?
And we are. And, but you have to take a look, Harry, that projection I just threw out there, because it's a pretty big spread between high and low. We're not talking over the next 6 months here. We're talking several years. I mean, don't expect oil to be where it was before it moved down significantly.
Were you surprised this summer? Because, I know the summer blends hit and then prices increase because of that, because there's so many these different blends that they're required during the summer, to have to provide. I was surprised because the summertime is when most people vacation and, you're using more gas in the summertime for vacations and other purposes. I'm surprised at how it's been coming down this summer. I didn't expect it.
Well, Harry, if you take a look at gas does follow oil to a certain degree. Yeah. With oil being down significantly over the last month, 6 weeks or so, it's gas will in fact fall. I mean, think about it.
How much do you think?
The price at the pump, the average price,
right?
Nationally speaking, right now is about $2.18.
Yeah, a lot less here.
We were at $2.04 at the end of the year, and a year ago we were at $2.75. So,
and we're in the 180s right now in this area.
Yes, correct.
Let me ask you this, Chuck. How much of this has to do with the fact that really almost at any time America could be more self-sufficient? We right now can produce half of what we use on a daily basis. If we opened up the spigot, if we did XL, Keystone XL pipeline, if we did a few other things, if we did more shale, we did more this, we did more that, we could be totally self-sufficient. How much are lower gas prices a byproduct of America being able to be more self-sufficient?
I think, Harry, right now it's just a matter of oversupply.
Okay.
It's not, I mean, wishful thinking is that, and we've talked about this for the last 25 years or however long it's been, 26 maybe with you?
26 years.
The fact that, we could be self-sufficient, but we choose not to.
Exactly.
For any of a number of reasons.
Environmental is the main reason. But I don't buy into any of that. We should be self-sufficient. We could be self-sufficient. And what a game changer it would be if I know there's other things that would be affected by it, so you have to look at the whole, the whole aspect of it. But Chuck, in terms of market leadership, what are your thoughts?
So before we go there, Harry, let's talk about the end of the week, because August 5th, big day for the markets. I mean, we're going to come with unemployment for the month of July,
right?
And I have heard expectations of 150,000 is probably the number that they're looking to print. But, what has happened over the last 2 months where, May was just way off the mark. June was significantly higher. So I think what happens, Harry, is these numbers, you have to take them with a grain of salt, and they sort of average out, over time. And I think the market's going to really take their cue moving forward with respect to what happens with the employment number. I mean, so, anybody's guess where we go. I'm guessing today being Tuesday, as we get to obviously into tomorrow and Thursday, that the numbers will be all over the place. And the number I've heard is about 150,000 is what they're looking for to be a decent number. So anyway, it's not to interrupt.
No, didn't interrupt at all. It's your show. But that's what's so ironic about that, interesting about that is normally considered a terrible number that wouldn't even keep pace with ins and outs, and you would lose ground at 150,000 in any other era other than this completely dishonest, intellectually dishonest era where the numbers are completely dishonest. We're looking at 150,000 would be great.
Well, look, I think we're all
incredible.
I think we're all looking forward to the next 98 days. Not so much what we hear over those 98 days, but just to get to the point where we can hopefully move forward, and the GDP that we know at 1.2 or 0.9, less than 2.5. We need to we need to figure out a way, and I know there is a way because we've talked about it, to be able to grow again.
And even though people would think this is the exact opposite, that like this is my Super Bowl, I live for this. I hate the 3 months prior to an election. I hate them because they're dishonest times. They affect our markets. They affect so many different things. I look forward to it being over, actually, because a lot of things happen because whether you're a political person or not, trust me when I tell you, everything is looked through the prism of this election for the next 98 days. And I don't think you disagree with that, Chuck.
No, Harry, it completely...
It's a shame. Shouldn't be.
We all lose focus, waiting for the next snippet, waiting for the next, interview, news conference, whatever it may be, to figure out,
what it means,
what a candidate says and what it ultimately means. So.
And they can make what they say mean what they want it to mean, too. So it's really pretty wild times. Chuck, were you going to speak about market leadership?
Yeah. So, Harry, here's what's happened. We've seen a shift of late, and it's good because the market leadership is changing. And as I mentioned in the beginning of the show, the NASDAQ, was suffering somewhat, and now of late has done relatively well compared to, the S&P and the Dow. But, cyclical stocks right now are we're seeing a lot more attention there. They have outperformed the low volatility, higher yielding sector. So I think your listeners, investors need to be cautious when they say, I want to own a high dividend pay stock because it's safe. Because of the levels that they are right now, you might want to be careful, and clearly understand what you're buying and why. But we think that, the movement into cyclicals and economically sensitive sectors, as investors are expecting better economic and earnings growth, as we get into Q3 and Q4. So with that being said, do you look at equities? Do you look at fixed income? We know, if we were to sit back 2.5, 3 years ago and say, Harry, the 10-year right now is at a 150, you or thereabouts, you would say, Chuck, you've got to be out of your mind. It should be close to 4%.
Right.
So investors continue to look for yield. Obviously, there is safety and stability in fixed income because in the capital structure, the bondholders are paid first, preferred shareholders are paid second, and equity folks are then they're basically last in line. So,
Chuck, how challenging is it when the yields are relatively tiny for tying up capital for an extended period? I mean, who wants to tie up 10 years for something small?
Well, Harry, I agree with you, but you have to understand that typically what you buy is negotiable and tradable. Obviously, the market, the market will bear the price, based upon the amount of time before the security matures, the interest rate tied to the security, and obviously the creditworthiness of the organization issuing the security. So you do have the ability to get out. So not that I'm suggesting you trade an account, but you do have, in fact, the availability to get out if you want.
In other words, you're not totally locked in.
Yeah, and think about it. If you had your money in and you were rolling certificates of deposit on a relatively short-term basis, and 5-7 years ago everything was great, where are you now? 25 basis points, 50 basis points, maybe 75 basis points. So you have to look at other alternatives. And the problem that a lot of investors are faced with is that oftentimes they are now venturing into parts of the market which they might never have entered into.
And now risk tolerance.
And you need to be, exactly, you need to be very, very careful and understand what you're buying and why you're buying it, because there is more behind it than the yield itself.
Chuck, I have to say, in your 26th year, you've gotten very smart. You're getting really good at this.
Well, thank you, Harry. I will take that as a compliment.
Anything in closing?
No, I think. Well, I'm going to leave on a good note. Yeah. I appreciate the vote of confidence. Thank you.
You have my full faith and confidence always. Chuck Malamut, for your financial planning needs, turn to Chuck and his team. The Malamut Group is at Morgan Stanley's Northfield office. Their direct phone line 609-383-2010. 609-383-2010 for all of your financial planning needs. Turn to Chuck and his team. The program you just listened to was presented by Chuck Malamut. He is a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. The presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. We'll be back in just a few minutes. Stay with us. 48 minutes past the hour. Phone lines are open at 609-407-1450.